If you enjoy this content, please take a moment to rate and review it. Your feedback will greatly impact our ability to reach more people. Thank you.
Okay, welcome to Hell Further. Today we have another guest episode, Dave Lambert. Dave and his firm, RightSide, have been partnered with Jumpstart, my VC firm, for a long time. Dave, thanks for doing this. Really appreciate it.
No problem. Happy to be here.
So it's the fun times in venture and SaaS models. Maybe for the audience, just give a little perspective on your background, how you came to be a VC, and sort of a little bit on RightSide. We'll get into it more, but just a quick synopsis of your background.
Yeah. My sort of 1 to 2 minute history is I grew up in Denver, Colorado, came out to the San Francisco Bay Area to go to college in the late 80s to early 90s. And then for the next 17 years, I was mostly an entrepreneur. I was CEO and founder of 2 tech startups. One was a computer hardware company. The other was a software company in the 2000s. I was a moderately active angel investor from the mid 90s to mid 2000s as well. And then, RightSide Capital started working on that in the late 2000s. We launched in the early 2010s. And RightSide Capital is a quantitative, data-driven approach to what we call pre-VC stage investing. So I think the sort of 3 unique things about us are, number one, that we focus on these small round sizes. So it's primarily $150,000 to $500,000 total round sizes. So that's sort of an area that's largely ignored by the professional fund world. The second unique aspect about us is this quantitative, data-driven decision-making process. So we gather up a lot of quantitative data points about a company, and that lets us make a yes or no decision, usually in about a week or less. And then we use that, the third thing is we use that to build out ultra-diversified portfolios. So each of our funds has many hundreds of companies in it. We're currently investing from our Fund 6, but we have over 2,000 portfolio companies since the early 2010s.
Yeah, excellent. Very good. So maybe let's just unpack for a minute how those kind of aspects of your background and RightSide offered maybe a different alternative to teams of founders trying to raise money. So you were a founder yourself, and now you've evolved, first angel investing and now fund investing. And that quick decision making is very unique in the market, and I think really welcome from founders. With, tell me that it's possible and let's move forward, or tell me that it's not right and I'll move on. But just an answer. Obviously I prefer yes, but no, a fast no is also useful. And then that several hundred assets in the portfolio, those 3 differentiators, how have they benefited RightSide, or how is that useful? Why is that important to RightSide's results?
Yeah, so I think, our sort of part of our core philosophy is both from being in the startup world and having been on the investor side, my partners and I came to the conclusion early on about 2 things. One is we were talking back in the late 2000s about sort of power law distributions and about how skewed the return curve was, and that the math sort of works a bit differently on top of power law distributions. So we knew, capturing these tail outliers was a key part of the investment strategy that we wanted to design. So basically our philosophy is that most of the returns are locked in the really 1 in 20 to 1 in 100 outcomes in very early stage venture portfolios. And we were even going earlier than traditional early stage venture. And you can't have a portfolio of 15 or 20 companies or even 30 and think you're going to get a 1 in 100 with high certainty. So our idea was, well, let's have hundreds of companies and we'll get our fair share of those 1 in 100s and certainly of the 1 in 20s. And then if we could do that, and so both of us, how do we do that? Well, you have to make quick decisions if you're going to have ultra diversified portfolios. And what's sort of the data logic and philosophy behind doing that? And basically both, a lot of it's from both entrepreneurial investor and sort of economic theory and engineering sort of backgrounds from myself and one of my other key co-founders came to the conclusion early on that for startups at this early stage, you can't know a lot more than the starting point. at which you're investing. And there's so many variables of uncertainty that our belief is that, humans were really using our brains to fool ourselves, to believe that we can predict all these various variables of uncertainty, not just that we can predict them, but we can predict them far out in time.
Right.
And that could be the case when, Nobel Prize winners in economics can't predict economies 6 and 12 months out.
Right.
And we felt there's more variables of uncertainty with startups almost than an economy, or there's more uncertainty with them. So anyway, that's sort of the reasons and the premise behind everything we do.
So a lot of my audience is learning about venture. Maybe they're a physician or running a health system, or they're in a startup, but they don't know the power law in detail. Maybe just unpack that a minute. So 1 out of 100 companies will drive some very large return. And then, so it's kind of the 80-20 rule, Pareto policy, thesis, but then, even more so, where like 90% of the return is in that top 10%, and even the 1% of 100 is massive. And so is that a fair representation of how you would characterize it? Or?
That is. Most people don't even understand the Pareto distribution correctly, because the Pareto is the 80-20 rule. If you say, 80% of our returns are from our top 20% of outcomes, but within that top 20, 80% of those returns are also in the top 20. Right. So even in a Pareto, it's 80 is in the top 20, but that means 16 is in the top 4%. Or, of that, or sorry, more than 80. It would be
4 is
80% of the 80, 64 is in that top 4%. So it's just a lot more skewed than people intuit. Yeah. And so you can't really solve that at these very early stages by just saying, well, I'm going to pick those 1 in 100 outcomes, but I'm going to do it 1 out of 10 or 20. We just feel.
So one of the ways that I would maybe simplify the RightSide model, but it's probably unfair, but just for illustration purposes, if you were to not know anything about 100 assets that you might invest in the next year or two, say 3 years, if you really thought it was a power law and 1 out of 100 of these unknown assets are going to be really good, picking a normal portfolio of 12 or 15 out of that would be foolish, right? Like you sort of blindly grab 15 of the 100 and hope.
They're positive expectation investments still, but it's really risky to have a portfolio.
Right.
And that's what most people don't get. Yeah.
Right. So if you lower the investment amount and get exposure to not 15 but 100, then you have much more freedom of opportunity. You're going to be in whatever that is 6-7 times more assets, and then you begin to make the law of large numbers move in your favor as opposed to against you.
Yeah, exactly. And I mean, most people misinterpret what we're doing and sort of use the derogatory term shotgun approach. And that sort of implies you're just shooting and aiming at any and everything, and you'll just take whatever you get. And that's not true. Like, we're very picky and we say no to almost everything we look at, most of the things we look at still. So you can still have very selective sort of target investment criteria and profiles you're going after, and build out ultra-diversified portfolios. So that, we sort of do both of those, and we've come up with this quantitative, data-driven way.
Yeah. The other thing that I bristle at is people talk about doing an index of all the, let me just grab, like you would in this public markets. I'm going to buy the S&P 500 and I'll get a broad collection that represents the overall market. In venture, that's a negative thing, because the overall market's not going to return an appropriately risk-adjusted return. And so you don't want to just invest in everything that comes across your desk. You have to be selective.
Yeah, there's also a high bar to even just, a somewhat high bar to even just have become a public company in the first place.
Right,
so there's been a lot of narrowing and winnowing down of companies to get there. Anyone can decide they want to go fundraise for a startup. So you can't just say, I'm going to index everyone who just thinks they have an idea worth funding.
Yeah. And then part of what the magic at RightSide is you have focused on SaaS companies, and maybe talk about that. I can guess about why, but maybe you talk about why that niche made sense.
Yeah, I think there's 2 or 3 reasons why we evolved to be very SaaS focused. We're not exclusively SaaS investors, but very heavy emphasis on that throughout our history. I think one is personally, I knew the model well. So my software company in the 2000s, we pivoted a couple of years in and we didn't even call ourselves. I don't know if the term SaaS was being thrown around then, but we pivoted to a subscription business model. And part of our sort of the DNA of RightSide Capital in the early 2010s was that the investor world as a whole still underappreciated how much stronger and bulletproof subscription business models were, whether relative to transactional ones. Back at that point in time, companies with SaaS business models that were public weren't trading, they were trading at slightly higher multiples than their transactional comparables, but nothing like today. And so that was one of our basic premises. And then also it turns out that in the very early 2010s, it was cheaper to build a consumer product than a B2C company, than a B2B company, because there were really huge headwinds selling into the enterprise space. They were reluctant to buy from startups. And if you could just get a TechCrunch article written about your consumer app or startup, you got 30,000 users overnight. And as the 2010s sort of played out and the cost to build software products got less expensive, the barrier and cost to build a B2B product actually became much cheaper than B2C, because you could acquire customers by just doing the calls yourselves as founders and selling them. And the cost to acquire initial users for a consumer startup became very expensive. You didn't get 30,000 by getting an article written about you anymore.
It got much more crowded, much more noisy.
Yeah.
Marketing channel.
So I think it's a combination of sort of a realization of sort of an underappreciation of SaaS. And so we felt they were mostly all undervalued in the early 2010s, to us sort of being at the right place in the right time, and us really also just following the market. If the market had gone such that consumer became a lot less expensive and was more capital efficient to build consumer startups, maybe we would have, actually almost certainly we would have had an emphasis on consumer. But because that was where the capital efficient trend went, we naturally became pretty heavily focused on B2B SaaS.
Yeah. And then that focus on the business model being not 100%, but a large portion of what you invest in is B2B SaaS. That then allows you to sort of take that data-driven approach, and you can use that business model to inform what metrics you're looking at. Even if a company is in healthcare or gaming or fintech, or almost different industries, you get diversification across industry, but that same business model. Is that close? Like some of the metrics you're asking sort of are tied.
Yeah. The unit economics translate across industries and verticals a lot. So, I don't care who you're selling to. If your price point is, once you start getting below $300 a month, it's really challenging to have a short enough sales cycle to sell. Even once you're under 500, it can be challenging. But, so if you're going to have a product and it's a $149 a month product, and you're planning on doing that with a sales force, your chances of success are really slim. It's just hard to do, and it doesn't matter what industry you're selling into. So those are sort of true facts across that are true on B2B SaaS.
Yeah, and so
where you're selling to, and there's a lot of other examples.
So that makes sense. The unit economics are really driven by the unit price, and then some kind of how long is one customer going to last, which would be the lifetime value of that customer, and that's compared to the cost it takes to get that new customer. And there's a ratio there that needs to be the right level.
Yep. But I think, one of the things we've learned in the 2010s and then the early 2020s, is that, macro matters. And we also were in an environment in the 2010s where there were a lot of tailwinds at the back of the SaaS business model. And I think there were two main ones that were going on that people weren't aware of or didn't appreciate as much. And I'd say we didn't, just like you don't realize you're in a bubble when you're in a bubble usually. And one of those that we're aware of, that was this transition in the psychology of enterprise customers. In 2013 and 14, if you had a $3,000 a month or a $5,000 a month product that you were trying to sell to large enterprise and you were a startup, your sales cycle could be 2 years. Like large enterprises, mid and large enterprises did not engage with startups. If someone bought your product, they felt like they could get fired if that product didn't work out and it was at risk. And somewhere between there and the end of the 2010s, there was this sea change, and it became acceptable. And mid to large size startups realized not only is it just acceptable, but the efficiency gains are enormous if we start using lots of SaaS products, and people realize they won't get fired if they use one from a startup and that startup stops existing. Like, you can adjust to that, and that presented major tailwinds. And then the other tailwind that we weren't aware that was happening, I think nobody was the labor war that sort of broke out in the tech world from like the zero interest rate policy being around for so long. So, SaaS was sold by seats, and you had existing customer bases with, no recession happening for a decade. So, and these labor wars, so the number of seats were growing. So it was really easy to be a SaaS business and just to have revenue go up continually, even from your existing customer base, because they were gaining employees, which were seats. And both those tailwinds turned around completely post the valuation bubble popping in late 2021, early 2022. So I think that purchasing tailwind still existed for much of 2022. Like, all of our portfolio companies, for the most part, hit their numbers. And then in 2023, almost every company of ours missed their numbers, because in 23 and 24, companies tightened their budgets when interest rates started rising. And they said, we're going to put a ban on any new costs on new projects. And all of a sudden, there was a headwind to selling to new customers that hadn't been there before. And then in addition to that, you had this shedding of all these excess jobs. And you had a lot of startups going under that were laying off people, and those are all seats. And so you had both an elimination of the tailwinds became headwinds for selling new customers, and your existing customers started shedding seats instead of gaining seats from laying off people. And then that has funneled into companies shedding seats because of AI efficiency.
Right.
So that trend's going to continue.
I mean, just to connect it back to where we started, if you built a portfolio of 150, 200 assets, when you had those strong tailwinds, you might have gotten maybe another 2 or 3 really outsized winners in that 150. Not because you chose particularly differently, but all boats rose a little bit.
Yep.
And now it's a harder market. You have to be more selective or more careful. Is that?
Yeah, that's very much true. I think people didn't realize the extent to which not only did you have the 2 tailwinds that I said, but you also had rising valuation multiples throughout the whole 2010s. So yeah, you could be mediocre and have good results.
Right.
Be, a true thing to say.
Yeah. And we should have covered this a bit, but you have a lot of experience investing in SaaS or businesses. 14 years, I think I wrote down over 2,000 investments across 8 different funds, and over 1,000 active portfolio companies today. So you have a very wide perspective of how this entire SaaS market is evolving in a way that not many other people do, really.
Yep. I would say that's definitely true.
Now, RightSide also has really worked hard at adding other things besides capital and support for your portfolio companies. Maybe just talk about how you think about that, and then some of the handholds or support pieces that you provide.
Yes, and when we started investing in 2012, it was just the 3 founders of RightSide Capital, and we were sort of limited in what we could do. We all had a lot of entrepreneurial experience, so we could help there. But as the decade went on and we got larger and we had more budget, we started looking around and saying, all right, what are the areas where we thought, we could impact the outcomes and returns of our investment the most and be most beneficial to our company? So the first 2 things we highlighted were sales help, because most of what we're investing in are technical founders who just aren't that experienced with the basic blocking and tackling of selling. So we brought in someone who's an experienced VP of sales, chief revenue officer, to provide free sales help and support on all things sales related. And then we thought fundraising was the next thing. And we had always had later stage investors reaching out to us or pinging us saying, hey, you guys could be a great source of deal flow. But when you have such a large portfolio, you only have so much time to connect the dots. So we brought someone in who's...
I'm living that every day today.
Yeah. So we decided we have a large enough portfolio that we have someone who's put a lot of structure and process behind that now. And the largest part of what they do is exclusively building out our investor network, keeping track of what it is their current focus is on, because that focuses are on, because for any given investor, that can change in any given 6-month period. And then working with our companies that are raising at all different stages and helping connect them to the right sets of next round investors, whatever.
Yeah, and it's really probably, I would think it's a curation process, right? Like you want to get the right investor connected with the right portfolio company or several portfolio companies so that it matches up. Is that right?
Completely, because if we blast a company out to a list of 140 investors and it's not a good match, A, that doesn't do much for that company, and B, then those investors start feeling that we're sort of spamming.
Don't want to see the next email.
So we do a lot of work to curate them, and we get a lot of feedback from our later stage investors, whether they're a seed investor or a Series B investor, that, hey, the stuff we send them is almost always right in their wheelhouse. And therefore, our emails to them get opened with a higher rate, because everyone's email boxes are, filled to the rim these days. And it helps our portfolio companies out a lot. So in addition to that, now we offer some, marketing help and support. We have monthly webinars. But, the two things we identified earliest on were, you have to be able to sell and you have to be able to raise next rounds of funding.
Yeah. Excellent. Now, let's talk about healthcare. You invest across industries. But the way we got together is you're interested in healthcare. Maybe talk about your views of healthcare and how it compares maybe to other industries in a SaaS investing perspective.
Yeah, we are interested. I think, if you look at us historically, there's two areas that we're slightly underweight compared to, the rest of the world and in the SaaS world, and that's probably fintech and healthcare, because those are two areas that, as it got cheaper to build products, you're still often selling into a regulated environment and longer sales cycles. And so we're mostly investing since the late 2010s in companies that already have revenue. And it was hard to get to a point where we already have revenue in those sectors, or it's harder. So we have a little less exposure, but healthcare is attractive to us on many fronts. One, it's just, we have an aging population. It's going to be a growing sector, almost guaranteed for decades to come. Number two, it's got a unique dynamic in that there are acquirers at almost every size and every stage you grow to. There are a lot of sort of verticals and sectors where you can outgrow your acquirers. And, maybe most of the acquisitions in that space happen at $50 to $150 million ranges. But at healthcare, there's almost always buyers at every stage, whether it's other private companies, private equity firms. Yeah. There's a lot of large strategic buyers. So that makes it attractive.
Yeah. Okay, excellent. And so let's talk about, I think you've referred to it as risk capital in the past, but like the amount of money it takes to go from like 0 to 1 in a software business, and how that's evolved from the 1990s through the 2000s to today. Obviously, everyone understands it's come down, but I don't know if people listening understand the extent to which it's come down. So you've been in this market since, I don't want to date you exactly, but before 2000, and you were building software businesses then. So just give a frame of reference so that a doctor or a healthcare person can understand how it's evolved.
Yeah, that's, I think, that people can't appreciate the change there as much. I'll go through that because I think we're both good, but we're also in the right place at the right time. So if you go back to the early to mid 1980s, it's $20 or $30 million to build a first version of a software product and get it into the hands of consumers to even just see if your business model would succeed or fail. It's really expensive.
Get that first product to be usable by a customer.
Let alone market it on TV or radio and go through distributors and buy in retail stores. And then by the early 2000s, through a combination of lots of things, including just software tools becoming more powerful, it was down to single-digit millions. And at the time, we thought, gosh, that's so inexpensive compared to how it's been.
Is that because of the cloud and open source, or is that even before those effects?
I think it was a combination of you started to have more powerful programming languages, software tools, libraries. Like in 1980s, you're building every single line of code from scratch. There weren't libraries you could call on. If you built a video game, everything was bespoke to that game from scratch.
I remember when it's thing called Power Builder came out in like 1993. It was incredible because it was basically a higher level 4GL set of UI and libraries, and you could build things probably 10 times faster, but 100 times slower than today, really.
Yeah.
Yeah.
So yeah, by the early 2000s, it was a combination of lots of things. Better languages, developer tools, uh, co-location facilities where you could store your servers, open source, all these different things. But that was just the beginning. By 2010, it was probably $1 million on average to build the first version of a software product. But it collapsed after then. By 2016, it was probably
before you
100,000.
leave 2010, because I think people won't appreciate the scale unless I underline it. So in the 1990s, 85 or 90, $20 million to get your first version out. By 2010, it's 1 million. Right?
Yep.
So that's a 95% reduction.
Right.
And then it kept going from there. So 2010, it was 1 million to get out.
Yeah. And then it just accelerated. So it was, 95% reduction, but over like a 20 to 25 year period. And then in the next, we'd say 6 years, it collapsed another 90%. So by 2016, an average of 100,000. It doesn't mean there aren't some areas like maybe fintech and healthcare where the average was higher, but there are a lot of areas where if you're 2 or 3 technical founders, it was zero. It was just your time to build that product. And that was a huge sea change. And what's interesting, I'd say there's a couple interesting things that you can tie into today's world is that the only area where it consistently got cheaper and cheaper over those decades was in building the first version of a software product. It did not become cheaper to scale out sales, marketing, any of those other things. Yeah. But that first software product version, became less and less expensive over time. And so that meant there's an explosion of new entrepreneurial activity in the software world. Every year in the 2010s, it just got larger. And that was sort of a unique time period as well.
Yeah.
And I think
once you got out there and you had a product that people started liking, you had to raise money to grow and to fight off competition and defend your market.
Yeah.
Which is useful if you're a venture capitalist, like RightSide, where you want to be able to deploy money. That has also been evolving over time.
Right. But you're still raising money usually to build out a company where you've at least proven some basic tenets of your business model. Whereas in the 1990s and early 2000s, when I was running my computer hardware company, we were doing network services and selling workstations and rack mount servers to all the 1.0, internet companies. And most of the customers we were selling to were burning through millions or tens of millions of dollars just to build a product.
Right.
They had no clue if it would work or not.
Right. Yeah.
Big difference.
Okay. So in 2016, 2017, it gets to be free. I agree with you. In healthcare, more regulation, more infrastructure, human life is at stake at times. And so it's not maybe quite as cheap, but the relative change has been the same, right? So maybe it was 10%, 20% more in the 1980s and 90s. It's still a little bit more, but the change, the delta has been similar. And now what have we seen since then?
So what's interesting, and this is where sort of AI comes into play, the big change that we've seen on our end is that trend of first version getting cheaper kept playing out into the early 2020s. Like, even in the late 2010s, we rarely saw someone that could build a high ticket enterprise SaaS product and have been bootstrapped or not raised a lot of dollars. But by the early 2020s, we were starting to see that somewhat regularly. The big change has happened in the last 2 years with AI, because as companies have integrated AI into their operations, it's made code writing that much more efficient and effective. You can do social media content generation. You can do your customer service and support more efficiently using AI tools. So I think this last 18-month period to 2-year period is the first time that I've been around where now we're starting to see this capital efficiency trend hit other areas, operational areas of a business. You can actually now do more with less in a lot of areas post developing that first version of a product, and you never could before. Yeah. So that's sort of exciting times from that perspective.
Yeah, and just to unpack that, the way I think people look, everyone has gone on to ChatGPT or others and like tested it for their own, intellectual curiosity. And certainly entrepreneurs and management teams of small growing businesses can use those tools directly. But then in addition, all of the enterprise SaaS tools Like I use Slack, HubSpot, Asana, Zoom. They all have AI in them too, and you can integrate them together. So on both fronts, you're able to use the tools to write your code better or do your particular job more effectively. So instead of hiring 10 people in the first year, maybe you only have to hire 3, 4. But then all of the software tools that maybe they're not core to the business, but they're all the infrastructure, the table stakes. I got to send out bills. I got to host things. I got to host a meeting like this. I got to communicate with my team. Those all have gotten much more effective too.
Yeah, exactly. So we're pretty excited for the coming years, because there's going to be companies that grow to very large revenues with much less employees than it was thought possible to do previously.
I mean, I remember Instagram really just my jaw dropped in seeing sort of they sold to Meta for something like $1 billion.
Yeah,
and they
like
had
a little
like
over
12,
$1 billion. Yeah,
they had like 12, 14 employees, something like that. That was the first time I really realized how impactful technology could be. But they were pre all of this stuff. So I think we're gonna see multiple $1 billion exits with 1, 2, 3 founders, just as like part of the landscape today.
Yeah. They're sort of the canary in the coal mine. They're the sort of signal of things to come.
Right.
It's taken a little longer, but what happened there can be explosion of companies like that over the coming 5 to 6 years.
Yeah.
Definitely.
And so, how does that change your perspective of sort of finding the right portfolio to invest in this market? And then in addition, this is having an impact on the SaaS business model. So maybe take that however you want to go. Like, how does it affect RightSide, or how is the SaaS business itself changing?
Well, I think I'm going to answer that second one first, because it ties into what we were talking about previously, is that fundamentally the SaaS business model of the 2010s is a permanently distressed business model in the 2020s, because it was all built off of per seat pricing.
Right.
And that worked great when we had a growing economy with companies that were net hiring. Mm-hmm. In the current environment, like look in the Bay Area and the tech world, like most of the large tech companies, their revenue's grown like crazy and their stocks are up a lot. And Google might be on its 6th round of layoffs since 2021 or 2022. So your existing customers are losing seats. So what do you do? Well, the subscription business model is starting to, and will probably very quickly move to, instead of seat pricing, some sort of consumption pricing model across the board for almost every product.
And that's needed in software because of the way that software is developed and deployed, right? The incremental cost, the marginal cost to add another user is very low. Maybe it's not 0, but quite low. And so companies need some way to measure how much are our clients using this tool? What is the value? How should we price this so that it reflects the value? And this per person or per seat license model made sense, because the more people that are using this tool, probably the more indicative it is of how valuable it is. But companies are now growing without adding team members, and yet they're going to use the software more and more with fewer people. So how do you measure that? What's the way?
Yeah, it's going to vary, and I don't think there's been like enough. There's not. I can't just say, hey, it's always these 2 or 3 metrics, because it varies on the business model. If you're selling a software product that helps people, a customer service or support platform software product, per seat made a ton of sense. But now if you've got AI in your product and it allows one of your customers to service the same number of customers with 8 people when it would have previously taken them 28,
right? Well,
you want to be able to charge them a similar amount. So you can't do it on per seat. Maybe it has to be per tiers of tickets or tiers of something, and it can be API calls on things. It can be bandwidth. It can be, you name it.
Yeah, because that dynamic is shifting itself. Like using my tool, if I'm a SaaS provider, you can just use a call center. You can service 3 people last year. You can service 8 people this year. Next year, you can probably service 15. And I need some model that will scale as the tool gets better, that sort of aligns my customers and me. Is that close to what you're saying?
Yep.
And what are the best 2 or 3 ideas? I mean, you said bandwidth and tickets. Are those what people are playing around with, or what are people, how are you measuring this?
It's varied a lot. So like I mean, I don't think, we have some company, I think most startups in the SaaS world still start at per seat when they're starting to get their initial customers, because you're mostly selling into smaller clients then, and that's actually still valid. And then as you get larger, you sort of pivot and change and you start to price it on something else. And sometimes that pricing is per some consumption. Sometimes that pricing is just per customer. Like our product is now, pick a price, 750 or it's $5,000 a month.
Yeah, no matter what you.
And or maybe it's tiered on something else. It can be 750, 2,500, or 5,000 a month. And I'm just basing it off some size that you are. And I don't, whether that size is revenue or a measure of something else. So it can be in tiers, it can be actual consumption usage. I think in general, you have to have tiers of something because your customers want to have a known budget that they're going to pay for.
Right.
But I think the SaaS world's just in the early stages of figuring that out. But when I say early stages, within the next 12 or 18 months, I think it's going to be that's going to be the default best practice for pricing.
Yeah. Well, what will happen is some group will find that it's an effective way to align their interests with their customers, and then others will follow it, and you'll end up with 2 or 3 standard business pricing models that is then populated through the whole market.
Yeah. Yep. Exactly.
Okay. Maybe let's shift to sort of startup and financial markets. I mean, you mentioned, and I learned the lesson over the last few years. I think all VCs learned the lesson that maybe we're not correlated directly to public markets, but we are really impacted by public markets. So how do you see the startup market as far as like deal flow, volume, quality, and then where do you see financial and exit markets headed?
Yeah, I think
we're talking now on February 11th. The Trump administration is changing every minute, it seems like, and so something could happen before this airs. But just what are your thoughts in general?
Yeah. I what I've learned over time is really trying to predict the future is sort of a fool's game. Like, I'd never met anybody in the last 14 years who along the way said there's not going to be a recession over the next 14 years, or might be 15 now. So it's just, you just have to sort of be prepared for all outcomes. I think what happened in the 2000s, the rising tide of valuation multiples, backwind of economic activity, all this hiring, is a lot of people in the venture world and a lot of new entrants ended up thinking, A, that they had picking ability that they necessarily probably maybe they didn't have because everyone was picking well, and B, that it was easy, and the reality is venture is really hard. It's a really long game, and macro trumps micro. So it doesn't matter if you're in an environment where valuation multiples are shrinking, your portfolio company's revenue can be going up, but their valuations are probably still going down, right? And that just hadn't happened in public or private markets in so long that people forgot that can happen. And I think that's just hit home hard now. I think we had such an expansion of economic growth and zero interest rates and people looking for more risk that a lot of money was plowed into venture. Way too many venture firms formed in the late 2010s into 2021 than should have. And now there's a culling of the herd. And, venture firms are going out of business left and right. They're investing their current funds and can't raise their next funds. And it's a slow motion train wreck that happens. It doesn't happen quickly. And that's healthy for the ecosystem long term, but boy, it's really painful for the startup world because just like there are that many more venture firms launched, there are that many more startups launched. Right. And so there's, 60,000 tech startups out there just, probably in the US that are looking for Series Seed and later rounds. And the number of investors writing checks is going down every year. And it's just way out of whack, the supply and demand imbalance of capital for the startup world right now.
Yeah.
So 2 positive things that we've seen post-election. You asked sort of regime change. I would say there's been a psychological change that's been positive. So I've had multiple portfolio companies say that amongst the corporate world, their pipeline has loosened up massively since November election. That suddenly profiles of companies and companies who had freezes on new cost centers or on buying new things, and that's gone away. And a lot of companies that have had some better months in December and January than they had in a really long time. So that's a net positive. I think we've also had companies hit by just the very sort of, like you said, things moving fast and changing in the early weeks of the Trump administration. We've had a number of companies who've felt they were very close to getting funding rounds done, and maybe they were in an area that was affected by grants or by at risk for regulatory change or other things. And those investors have all sort of taken a step back and said, hey, let's revisit this in maybe 3 or 4 months when we can see how this all plays out. So I think some of what's happened in the first few weeks has had some as negative in the startup.
Yeah. So there's two aspects to this. I agree with the psychological shift. I think people are optimistic about like the economy in the longer term, like say 6, 12, 18, 24 months, and are interested in innovative products and new ways to approach things where maybe pre-election, just with the uncertainty of who's going to win, what's happening, almost, I don't know if it would have mattered who won, but getting past that point, and then with the Republicans winning, has definitely been positive. And then definitely in healthcare, the regulation is complex. There's a lot of worries. I don't think we're going to have to take care of our people that need healthcare as a country. And so the system is going to be there, but how the $4 trillion is spent and, are there places to cut back that are good for taxpayers, that are not good for startups? It's hard to know that.
Like there's a lot of business models in the healthcare world that are predicated on a large portion of your dollars coming from Medicaid.
Yes.
Consumers, like you're servicing that.
Medicaid and Medicare, over half the revenue on an annual basis comes from the federal government. So certainly a lot of regulatory.
Yeah. So investors got freaked out when all the grants and everything was shut down briefly and Medicaid was sort of unfunded for a day or two, a lot of aspects. Suddenly, any healthcare business model where suddenly that is going to have a big impact, investors are like, I think we'll wait a few months and see what happens before funding you. So those are just some of the real healthcare challenges right now. The flip side is, we've had some other companies, we had a company, I won't name the company, but they were in a sort of an insurance area. And there was some concern by a lot of investors leading up to and after the election that Trump might be a headwind for this type of product. And it's turned out that it's likely a tailwind. So you don't always know how things are going to go. So some things have played out more favorably. But uncertainty is going to be the enemy of a lot of healthcare.
Yeah. Well, and the timing is just different for the founders and the management teams than it is for the investor. Like an investor can see the first month of the Trump administration and say, gosh, I'm going to pause investing for pick the amount of months, 3 months to see what happens.
Right.
But there are companies that they counted on getting this deal closed by March 1st and they're out of money. And so they can't just take a pause.
Yeah, that's the pain part. Exactly. And that's going to happen.
And what are you seeing on the deal flow side? You see probably the most deal. I see a lot of deal flow and you see probably 5x that because you're across everything. What's the deal flow side of things? What are entrepreneurs feeling?
Yeah. So I would say from the deal flow side, as an investor that's had investment dollars to invest over the last bunch of years, why it's the hardest fundraising environment, in a long time for startups and maybe ever for VC firms. If you're investing and writing checks, it's one of the best environments ever, right? So it's sort of like the dream environment for deploying capital. So, that's the flip side of the coin is we've never seen a better time frame. The combination of just sort of the acceptance of buying products from startups from the larger corporate world, the general capital efficiency trends in building first products, AI capital efficiency, like all that's coming together, and it's sort of as good as it's ever been on the check side.
Yeah, the difficult reality of, I'm going to say half, maybe more than half of venture capital firms that existed in 2022 will not exist in 2026. They just half are going to be gone.
Exactly.
That
That's
is really hard if you're raising money. It is beneficial if you're trying to deploy money because obviously there's fewer people to compete with.
But here's a change that we've seen and witnessed that we hadn't sort of factored in that's really positive from all this, everything that's happened over the last couple of years, which is in the late 2010s and early 2020s, without knowing it, a lot of the startup world, both on the investor side and entrepreneur side, had almost absorbed a lot of the sort of the spoof Silicon Valley TV show mentality. Like suddenly the goal of startups from founders' perspectives was not to build profitable, successful companies. It was to get to the next round.
Yeah, get to the next round.
What do I need to do?
Get the breakfast bar and the foosball table and all the trappings. And then we'll figure out how to do something that makes money later.
Perks to attract employees, and what do I need to do to get to a next round? And then anyone on that path blew up and died or did massive layoffs and changed. It's been a sea change from a psychological perspective in the entrepreneurial world. You know, what's happened in the last few years. Suddenly we have this new generation of entrepreneurs who believe that they can't rely on a next round of funding being there. And therefore, they have to build capital efficient businesses whose primary goal is to figure out how do I get profitable and growing so I don't die if something like what just happened in the last few years happens again. And I've never seen it where that's the default mindset of entrepreneurs before. So I think it's just super healthy for the ecosystem to have that be the default mindset going in for most tech founders, because it certainly was not like that from 2017 to 2022.
That's the tagline that people will throw around, like default alive. Like, how can I organize my cost structure and my cap table and the way I run this business so that no matter what happens outside of this business and the team of people I've associated myself with, customers might leave, investors might not show up, we are going to be alive and sustain ourselves through whatever challenges come. That has not existed. I agree. I've been doing this 25 years. You've been doing it a little bit longer, ever. So it's really healthy to see that. Now, it might we might lose some of the super growthy, explosive companies, but I will take that for more efficiency, more reliability, more resiliency.
Yeah, completely. I mean, it's going to be interesting to see how it plays out because it will cause some of those changes. It also brings into question what's the role of the later stage investor world in the venture, arena where, large $50 to $200 million rounds were being thrown around and taken very easily. Will those be needed as much? That it will definitely be the case that a lot of companies still go on that path and need that, but it might be a much smaller number over the coming 5 or 6 years than it was over the last 10 years.
Yeah. I mean, I think I'm preaching to the choir here, but as small fund managers, our funds are $20 to $50 million in size. RightSide is maybe a little bigger, but you're investing in a lot more companies. I think that's healthy. I mean, the $1 billion Series A investment is just not a thing that is healthy, I don't think.
Yeah, no, I would agree. I think most people agree with that now in hindsight.
Okay, close it out with, you've been doing this for a long time, and you have a perspective that is really broad across the whole software landscape. Where do you see the market heading? Where's RightSide sort of making slight changes or big changes? How do you see the future playing out?
Yeah, I mean, I think the future for now is that we can see easily is that AI is just absorbed into everything. It's AI. You're not going to be considered an AI company in a year or two if your product has AI built into it, and if you are using AI in your backend operations, that's just going to be table stakes to be an organization that's efficient enough to compete with its competitors and to have a product that has enough functionality to compete with everyone else. And it's just, it's going to be a renewed focus on business models and providing value to your end customer. And AI is going to be a part of that product that solves that. And that's just the way it's going to be.
Yeah. So I've been talking about AI as similar to the internet, where there are no internet companies today. I mean, there were in 1997, because it was new. And just like that, I mean, now we're a couple of years into AI, there are AI companies, but it just becomes, it's just one of the tools that everyone uses. And some people use the internet better than others, but everyone has a web page, and AI will be the same. It's just like part of how you build your business.
If you go back long enough, at one point, databases were unique, new, and novel, and almost no one used them. And web pages, websites, and being able to sell on the internet was unique and new, and you were a web company if you just did that, even if you're a brick and mortar retailer. And that same phenomenon's happened with the term AI, and now it's thrown out towards companies, but AI is just going to be a built-in part of the landscape. And the AI companies will be the foundational companies and people doing really hard science around AI, and everything else will be using AI mingled into everything, just like how the web and the internet's mingled into everything.
Right. Okay, excellent. Now, where should people learn more about RightSide? Is the website best? I'll link to it in the show notes, but how should they learn more about what you do and your portfolio?
Yeah, if you go to our website, it's just rightside.capital.com. You can learn a lot about us. If someone wants to reach out to me directly, its email address is dave@rightside.capital.com.
Right. Great. I'll put these both in the show notes so that people can easily just link to it. But Dave, really appreciate it. Anything we didn't cover that we should have?
No, I think we covered a lot. It was a great discussion.
Yeah. Thanks for doing this. Really appreciate it. And have a good day there in California. Appreciate it.
Thanks. You too.
Okay. Bye.